Hi, everyone. I'm Veronica Kazanjian-Babian, Associate Director in Alumni Relations and a graduate from the class of 1995 from Thomas Jefferson University. It's my pleasure to welcome you to our Financial Planning for Today and Tomorrow talk. We're thrilled to welcome back alumnus Michael Zimmerman of Regal Wealth Advisors, who will offer planning tips to maximize your financial future. Some of you may recall that Mr. Zimmerman was featured in our tax savings tips talk last November. He'll once again be joined by Jefferson's Kathy Sarlson, Assistant Vice President in Plan Giving, and together our speakers will explain ways to manage your finances for the present and future. Thank you so much for all the questions that were sent in advance. These have been passed on to our speakers, and many of them will be addressed this evening. At the end of tonight's presentation, you'll have an opportunity to ask further questions. And now it's my pleasure to introduce our featured guest, Mr. Michael Zimmerman. Michael Zimmerman graduated from Thomas Jefferson University in 1998 with a degree in biochemistry and minor in finance. He earned a master's degree in organic chemistry from the University of Texas. Michael has earned the designation of Certified Exit Planning Advisor, CEPA, and has completed coursework in retirement income planning, legacy planning, and Social Security planning. In this field, he has received award recognition as a top 10 wealth manager in the Central Pennsylvania Central Penn Business Journal, and was also named Central Penn's 40 Under 40 in 2015. Michael and Kathy, thank you for joining us this evening. The floor is yours.
Thank you, Veronica. I definitely appreciate that kind introduction, and am happy to be back on the stage again, so to speak, to talk about financial planning for today and tomorrow, and kind of overwhelming to see the number of guests that have joined us. Kathy and I hope to answer many of your questions. We tried to put that into our presentation, and part of my passion with my business is to educate as much as possible, so let's hope we get that accomplished tonight. Like she said, there's our credentials. I do have to read a few disclosures for both of us. This workshop is definitely for educational purposes. Jefferson and Regal Wealth, we're not giving you direct tax or legal advice. You do need to consult your CPA or tax professional if you do want more information. And Jefferson is not endorsing me in any way, shape, or form or any specific professional advisor. And just for my benefit, I do have a broker dealer that likes to see their name everywhere as well. So we got them on there. Okay, what do we plan to cover tonight? Well, I think it's important to talk about current tax law. We have had a change of administration, talk about a little bit of what we see down the road. But more importantly, I think it's important to know what's been in the recent bill called the Secure Act. We're going to transition to traditional IRAs, Roth IRAs, and work plans. We had a lot of questions around what should I be doing? How aggressive should I be? So I think we need to talk about that a little bit. I'd like to transition a little bit also into alternative wealth strategies. We had a lot of questions about different investments. Should we use life insurance? Are there other investments than the bank out there? So we're going to talk about that. And of course, I think most importantly, we need to talk about charitable giving, because with a lot of these recent law changes, there's a lot that can be done to save you in taxes, but also benefit your family and your favorite charities. So let's get going. Part of my passion is I think 50% of investing is knowing the rules. If you don't know the rules, how can you effectively put a strategy together? And I don't care what strategy you use, but a strategy isn't meant to be broken every 2 minutes. Know the rules, put a strategy together, and stick to it. And that's kind of what we're trying to present tonight. What strategy is available for you to use? So let's begin talking about some current tax law and the Secure Act highlights. Well, I think we begin with talking about the tax brackets. We've been in existence with tax law since 1913 with the 16th Amendment. And currently we have 7 tax brackets for single individuals, married individuals, and head of households. I think it's important to know how they work. And let's just talk about a single individual, for example. The first $9,950 is taxed at 10%. The next above that, $9,951 to $40,000 is taxed at 12%. Many people think that, oh my goodness, if I go $1 over, I'm going to be taxed at 22%. No, it is progressive. Only the amount in that tax bracket is taxed at that dollar value. And that's important to note because we're going to come back to this. It's very valuable to take advantage of the full bracket. Let's take a married couple that might fall into the 22% bracket with $100,000 of taxable income on line 15. Well, before they go up to the next bracket, they have $72,000 more of income they can have or use for their advantage in tax planning before paying more in taxation percentage-wise. Important to this concept, and where Kathy's going to step in on the next slide, with the rule change in 2017, we used to be able to itemize all sorts of deductions, giving to charity, maybe our favorite church or organization like that, and itemize that off. But now most people are only able to take the standard deduction. And for a single filer, that's $12,550 in 2021 and $25,100 for a couple. So it's kind of hard to get over that threshold. But here are some other ideas to maybe take advantage of not just the standard deduction, but to increase your tax savings.
Great. Thanks so much, Mike. And although I cannot see all of you, we're so excited that you are there. Our alums are really our greatest point of pride for all of us who are working at Jefferson. So we're so glad you're joining us. So as Mike mentioned, the 2017 Tax Cuts and Job Act really changed the whole structure of how we all are taxed. And while there were certain things that were changed, increase, decrease, kind of the biggest pieces of it are that, as Mike mentioned, the standard deduction, it increased quite a bit. It almost doubled, going from around $6,000 to around $12,000 for single filers. At the same time, there were new caps put on in terms of how much you could deduct for your local and state taxes. And for some people, they were also affected by caps around how much of their mortgage interest they could deduct, which tends to impact people really more in states like New York and California, where real estate is much more highly valued. But as a result, and in fact, one of our alums commented on this when he RSVP, he said, I kind of miss those days when I could deduct all my charitable contributions. I know myself, I've used to do my own taxes and I'd be on the little program. And every time I typed in each one of my charitable contributions, I watched how, what I had to pay in taxes went down. But now, just with that change between 2017 and 2018, the percentage of people who itemized, these are rough estimates, went from nearly 30% of tax filers to about 11 or 12% of tax filers. So it's really had a really large impact. And if you're somebody who would take the standard deduction, but you're thinking you would like to take a larger deduction and you're philanthropically inclined, here are three strategies. The first two are about the deduction itself. So one is if you're somebody who tends to make pledge payments, pledges to different charities, it might be your alma mater like Jefferson, it might be your place of worship or other kinds of organizations. Let's say for someone who made a pledge of $10,000 and they were planning on paying it over 4 or 5 years, they might want to consider front loading to just do in 1 or 2 payments. And that may enable them to kind of get over that threshold so that they can deduct that. The other option that people have is if you currently have what's called a donor advised fund, you may want to consider contributing more to that in a particular year. What's great about donor advised funds is The year that you put money into it is when you get the tax deduction. But you don't have to make grants out of it to charities. It's really on your own timeline. It can be in future years. So for some people, that's a great way to get a tax deduction, move some of those assets into the donor advised fund. For people who are over 70 and a half, you can give directly to charity from your IRA. We're going to go into more details in a few minutes to talk about how that works, but that's another way to give to charity, and then you can avoid having to pay the income when the money comes out of your IRA. But we'll get to that down the line.
Thanks, Kathy. One area I'd like to go over as well, it's been a source of confusion a little bit lately with some of the recent tax law proposal changes that are yet to be passed, are capital gains rates. Depending on what your income limit is, you could have anywhere from a 0 to 15 to 20% tax on capital gains. And the way it works, again, we can just use a single filer here. Let's say you have highly appreciated stock that you've held for a long time, or maybe a second residence that has a gain of $100,000. Well, any gain over $40,400 and up to $445,850 is taxed at 15%. One of the proposals is to say if you make over $1 million, that this 20% rate is going to go to the highest current federal tax bracket of 39% plus the 3.8 Social Security / Medicare tax. So there's been some concern that this may cause a stock market to correct. I don't feel that personally, but just want you to know where the capital gains rates are for now. I think the biggest one that people are thinking of that could be changed is the step up of cost basis. Let's say you plan to leave a house to your beneficiaries, and currently, if you pass away and leave the house, your beneficiaries get to take the current cost basis and step it up to today's value. So let's say your house might be worth $600,000, or a stock for that matter. The cost basis of a stock today's it's worth $600,000, and your cost basis is $200,000. If you pass away, they get to take the step up all the way to today's current value of $600 and avoid taxation. Part of the proposal in front of Congress right now is that they take that away, and that taxes could be due on that whole gain. So there's some concern there, and that does affect everyone, not just those people making over $1 million. And if you have concerns around that, feel free to shoot me an email or ask your accountant what that may do to you. But I think it's important to understand capital gains a little bit as it relates to future financial planning. Okay, I'd like to move on to the Secure Act, passed at the very end of 2019, right before this wonderful pandemic hit. So a lot of the rules were overlooked because there were other pressing items going on. I think it's important to recap some of the highlights of the Secure Act and how it might specifically impact you and your retirement plans. And this impacts not only just people in the working phase, but also those of you in retirement. So we're going to hit a couple key areas on both phases of the game. I'd say the biggest change is that people now have more time to save for retirement, more ways to save, and more ways to use the funds that maybe life changed and you need to access them. But the biggest change, I think, for me is that there's more time to save. Those people that are over 70 years of age, 70 and a half before, weren't allowed to fund retirement plans on their own. But now, as long as anyone has an earned income, you're allowed to save. And we'll talk a little bit more about that in the coming slides. But one of the biggest changes was the change of RMD age. But I want Kathy to spend some time talking about what you can do with your RMDs as it relates to ways to save money in financial planning.
Great, thanks so much. So one of the things that we've talked about a lot is how you can use your IRA to give directly to a charity. And just so you know, year in which you had to take a required minimum distribution has gone up. However, you can to 72. However, you can still give to charity from your IRA starting at age 70 and a half, even if you haven't reached that time of the required minimum distribution. And one of the reasons why there are a few reasons why people consider using their IRA. One is they may want to start reducing the size of it because they know that as it grows, they're going to have to take a larger RMD and they're going to have to pay taxes on it. And so that is one reason. The other is sometimes people like to think of it almost as a charitable piggy bank, that if you're thinking about writing a check or giving stock, which is also a great asset to give to charity because you can avoid paying the capital gains. Another option is to look at your IRA. And so on the next slide, if you want to keep going, there are a couple rules about it. And just so you know, if you decide you want to use this asset to make a gift to Jefferson, and hopefully this is true of any charity, we are very happy to work with you and your plan administrator and walk you through it. But here are just some of the basic rules. You need to make the distribution before December 31. You have to be 70 and a half. And it has to be from a traditional IRA, not a 401k or 403b or any other kind of employer-sponsored plan. One person in a married couple can give up to $100,000 annually from an IRA, and spouses can each transfer up to $100,000. And the most important thing I always tell people, because we've had a number of gifts made this way from our alums, is that the transfer has to go directly from your IRA administrator to Jefferson. You can't take the income and then write us a check. It doesn't work that way, unless the exception is if your plan administrator gave you a checkbook from that plan, then you can write the check. But generally speaking, you would ask your plan administrator to make the distribution to the charity. And as I mentioned, we're happy to help you with that.
Yeah, I think that's a great concept, a complete reduction of income for any qualified charitable distribution. I'm going to go quickly through a couple of the next slides because they're important, but I don't want to take time away from some of the more important topics to follow. One of the things of the Secure Act, if you were a part-time worker before, you weren't allowed to participate in employer-sponsored plans. And sometimes there's free money to be had because employers give matches. So if you are a part-time employee and at least work 500 hours, you might be able to now participate in your company plan and take advantage of that. Some of the details, it's great for part-time workers, maybe stay-at-home moms, stay-at-home dads who are doing caregiving but have a part-time job. This is a new way that you're allowed to participate. So take advantage of it if you're a part-time worker. What if you're a new parent, just recently trying to have children or maybe looking to adopt? Before, you could not pull money out of an IRA without being subject to the 10% penalty if you were under 59 and a half. Now new parents are able to take $5,000 from their qualified plans, their IRAs, or even Roth IRAs without paying the 10% early distribution penalty. So if that's affects you, part of knowing the rules, maybe not completely the best option for getting money right now. There's other ways to do that, but if that's your only source, hey, here's a way to avoid a 10% penalty. Another thing, speaking to Jefferson University, this rule was actually kind of nice. I thought about this when I was in grad school. Graduate students and postdocs weren't eligible to put money into IRAs and Roth IRAs before this recent rule change because stipends and non-tuition fellowship payments were considered not earned income, but now they are considered earned income, and definitely take advantage of it if you have the ability to put money away. Roth IRA is a great way to do that. And on a similar note, considers the saver's credit. We had a few questions that were asking, hey, I just started a career. I don't have a lot of extra income to put away, but this is a very unknown or little used tax loophole that if you're a low income worker and say 33,000 or below for a single filer or 66,000 and below for a married couple, you can put up to $2,000 away in a Roth IRA or a traditional IRA and take $1,000 off of your tax bill. Something that I use for my younger clients, and even for my my clients that are well-to-do and have kids or grandkids that just started a job. It doesn't matter where the money comes from, as long as you have earned income. A grandparent or a parent can add money to an account for a child and help them get that $1,000 tax savings. Great little loophole of the code. What about 529 plans? I like them, but had trouble recommending them in the past for an infant because who knows if they were going to use that money for education. But one of the benefits of 529s now, they can be used for almost any type of education, private education, kindergarten through 12th grade, not just higher education anymore. And one of the other options here, what about student loans? If you're paying off debt, an option could be start a 529 plan because you're allowed to withdraw up to $10,000 tax efficiently from one of these plans to repay student debt. And if you're like me, I had some too. So this would have been nice to know or have back when I was paying off my college debt. All right. Wrapping up the Secure Act highlights, I think this might be the most important piece of legislation that came out because it changes the game completely with respect to IRAs. In the past, if you had an IRA, you could leave it to your spouse, which you still can, and they inherit it as their own. But if you left an IRA to a child, a grandchild, they were able to inherit the IRA and spread the taxation over their lifetime. But the recent rule change says if a non-spouse inherits an IRA, including Roth IRAs, they must be liquidated and spent within 10 years. To throw a little monkey wrench on top of that, the IRS just had a publication 590 that says, we're not sure if we know our own interpretation of the rule, where you might still have to take out a little bit each year in those 10 years and then cash out, or maybe you can just leave it sit and cash out at the 10th year. So there's still some controversy in the interpretation of that law. But what is clear, the stretch IRA is definitely gone, and the accounts have to be liquidated in 10 years, which changes the tax game completely. What do I mean by that? This makes it kind of important to start looking at Roth conversions and maybe even considering using your IRA to pay for life insurance as a way to transfer assets to your loved ones and beneficiaries tax-free, and maybe leaving the IRAs to your favorite charities. Example, maybe Jefferson for that matter. But what is clear for my clients, we are reviewing beneficiaries. Are your kids the beneficiaries of your IRA? If so, is that the correct treatment of all your accounts, or should they be the beneficiaries of other accounts? Definitely, we want to talk about trusts here. Are the trusts the places to put IRAs? Probably not with this new rule change. But it's clear to me that if you have IRAs, you need to start developing a distribution plan. Should you spend those first versus your other retirement accounts? Should you make charitable contributions in the form of qualified charitable distributions out of those IRAs? But you need to manage your tax bracket. Take advantage of what's available to you now, because there more than likely could be more rule changes that we need to be pretty aware of. So these IRAs could be ticking time bombs if you're not paying attention to your beneficiaries of who you made on those accounts. But creating an estate plan that makes sense for you and your loved ones is very imperative right now. All right, enough about the Secure Act. Let's talk about some of the big topics of questions that came in: traditional IRAs versus Roth IRAs. What should I be doing with my company plan? In company plans, we're talking about 401ks, 403bs, 457 plans, TSAs, what have you. And I want to go back to when these plans were all implemented. And this is the history of taxation in our country. Again, starting back in 1913 with the 16th Amendment, we saw tax brackets skyrocket to as high as 94% back in the 40s and 50s, only to start coming down a little bit and into the 70s, still hitting a top of 70%. This is when company plans came into existence, when the average tax bracket was 43%. So it made sense back then to put money away, not pay tax on it, hope that it grows, and then spend it in a lower tax bracket in retirement. Well, that clearly was a great model back in the mid 70s when these plans were implemented. But fast forward to today, we're nowhere near an average bracket of 43%. We don't even have a tax bracket that's 43%. So it might not make sense to put money away tax deferred anymore. So a good example I use living here in Lancaster County for a lot of our farming clients: if you're a farmer, would you like to pay tax on the seed when it's a small amount, or do you want to pay tax on the entire harvest? That's a pretty important question, because with most 401k plans, not a Roth 401k or a Roth IRA, traditional 401k plans, you're taking a tax break on the seed and letting it grow to a much larger harvest where you're going to owe tax on the whole thing. So what I tell my young investors and even my retirees, why wouldn't we pay tax now in the lowest brackets in the history of the US and let our money grow tax-free and spend it later in life tax-free? So hopefully that makes sense to you. So what can you put money into? Well, if you have a job, and I'm going to be the first one to recommend this, check out your company match. If they are matching, you have to at least put in what they're matching, because that is 100% free money. And instead of just putting it into the traditional options, check if they have a Roth option. If they have a Roth, I highly recommend taking advantage of it. If you're under the age of 50, you're allowed to put as much away as $19,500 this year. If you're over the age of 50, you get an additional $6,500 of catch-up provision. So you could put $26,000 away in tax-free accounts. Now, if your company is matching, their match goes in the traditional bucket and will be tax-deferred growth. But if they have a Roth option, take advantage of it now. Those of you without company plans have the ability to put into your own IRAs or Roth IRAs. Current limits under the age of 50, 6,000. Over the age of 50, you can add an additional 1,000 for a total of 7,000. Okay. 401k contributions are not generally phased out based on income. So even if you're a high net income earner, you can still take advantage of a 401k plan. If you are a high income earner, you probably would not be able to put into your own IRAs or Roth IRAs. Those phase outs start at $125,000 for a single filer, $198,000 for joint filers. We did receive a question, though, if you could contribute to both. And I want to just address it now, because I tell this to my own clients all the time. 401k plans are great, especially if a company's matching, but they are generally limited on the options you have to invest in. So what I generally would say is, let's say your company's matching 6%. Definitely put 6% into the company plan, but maybe start contributing the rest to your own IRA or Roth IRA, or an alternative that we'll talk about later, because these plans have unlimited investment options and not so much tied up to what just the 401k could offer. Hopefully that answered that question. Also, we received a question about the aggressiveness of what you should do inside of these plans. If you're a young investor and you're putting money away into a Roth or even a 401k, you have time to be more aggressive. The older you get is when you want to start paring that aggressiveness back. Okay. So which is better for you, a traditional IRA or Roth IRA? We talked about the advantages of money growing tax deferred and then being taxed on everything when you pull it out. RMDs are required, where a Roth IRA, you pay the tax now, but the money grows tax free and can be pulled out tax free later in life. And you don't even have to take the money out if you don't want to. So you might be asking, Mike, I put money away into a traditional IRA all my life. Should I use the Roth now? Am I too old? Am I too young to do this? Well, I'm not telling you to take everything out of a traditional IRA and put it all into a Roth right away, but I did mention the tax brackets. Maybe you should take some of your traditional IRA out now and pay tax so that it can grow tax-free forever. Remember those tax brackets we talked about? This is what I'm saying. Take a look at line 15 on your tax return from last year. That represents taxable income. Let's say we're a married couple, and again, I'll use the example I started with, have 100,000 on line 15. Before we go up a tax bracket, we have $72,000 more of income we could add to our revenue or our income before we go up to the next bracket. So what I'm saying is, if your taxable income on line 15 only fills up part of that 22% bucket, take money out of your IRA and a Roth conversion, fill up the bucket, pay the tax now while we're in a 22% bracket, and get the money tax-free forever. It's a great strategy. Don't hurt yourself with taxation, but take advantage of the current brackets. They are super large. All right. Some of our other questions. What money should I spend first? Should I pay down debt? Well, I'm going to talk about retirees and those of you working. I think we kind of all fall into the same buckets. So for retirees, traditional and conventional wisdom used to say, hey, spend your bank accounts first. If you're retired, get Social Security early. Let your IRAs grow to a much bigger nest egg, and then spend IRAs last. Well, I kind of disagree with that strategy because I think it's the government's plan. It provides them the most tax revenue on your assets. So one thing we talk about, and I have some articles in here that you can feel free to look up, but it talks about tax efficiency on how to spend money. And what we tend to do here is tell people, hey, that IRA could be a ticking time bomb. I'd spend that first if I'm in retirement. Or start converting some of the traditional IRA to Roth IRA in low tax years. Hold off on Social Security so that it grows at that 8% step up that it provides. Don't take the penalty to file early, and then spend bank accounts, but always spend tax-free money last, whether that's life insurance or Roth IRAs. What about those of you working and trying to save? We are currently borrowing money at historically low rates, where I have people saying, hey, should I pull money out and not put money into my 401k or Roth IRA to buy a car or pay down my mortgage a little faster? Absolutely not. Do not do that. I think smart money says if we have low interest rates, borrow the money, pay off what you need to, be active, don't be late on those payments, but invest in yourself first. Max out Roth IRAs the most you can and your 401ks. Don't just pay down debt to pay down debt at historically low rates. We're not paying 7 to 15% on mortgages anymore. They're 2 to 3. So take advantage of that. Also, a lot of clients are coming into me saying, hey, I've had money sitting at the bank for a long time. It's made nothing. What can I do with it? Well, one idea for younger folks is open a small investment portfolio in a very conservative portfolio, not taking a lot of risk, but at least you have the opportunity to make some returns rather than guaranteeing yourself a zero return at the bank. And I can talk more about that if you're interested. All right. I know I'm moving fast, but time is kind of getting away from us here a little bit too. We had a lot of questions about alternative investment options. And there's more to the investment game than just the stock market. There's annuities, there's life insurance, there's all sorts of things. And there's also more to tax efficient investment than just Roth IRAs. So I thought I'd spend some time talking about those. So Roth IRAs and 401ks, traditional IRAs revolve around IRS code 101A. Well, there's another IRS code called 7702 that also deals with tax efficient growth of money with the ability to pull money out tax-free, pass money on to your beneficiaries tax-free, and maybe even use some of it tax-free for long-term care, which has been a hot topic lately. So I like to give case studies just to maybe have a better understanding of how this could work for you. I use Dr. Jane. She's age 55. Her goal is to retire in 10 years. At the age of 65, she's currently putting money into a company plan, but has an extra $2,500 a month she'd like to save outside of a company plan in a somewhat conservative investment. She loves the idea of Roth IRAs and wants tax efficient growth, and she's looking to maybe pull the money back out tax-free in retirement. And she may also have some long-term care concerns in retirement as well. So what we do is establish an account where she starts putting $2,500 a month in. And sorry for the small print here. It's hard to get everything on one screen. But let's say it's $30,000 a year going into an investment account. And if Uncle Sam lets it grow tax-free, there has to be some time involved here too. So let's say she does this for 10 years, $30,000 a year every year for 10 years. This the middle column here is worst case scenario. This is contractually guaranteed where it says if there's no earnings in the market, we'll at least guarantee this to you. So if the market was negative for 10 years, let's say in a Vanguard account, 300,000 could be worth very little. Well, here worst case scenario is our 300,000 is only worth 273,000. I'm kind of done with worst case scenario. I think these perform well enough to say, hey, this is a pretty conservative investment. After 10 years, her 300,000 is probably worth 324,000 for tax-free income. But take a look here on the other side. Any time along the way, should something happen to Dr. Jane where she's not with us, her money turns into over 600,000 for tax-free benefit to her family. Growing each year she puts money in. So at year 10, there's 324,000 of tax-free cash available, 922,000 of a tax-free death benefit that could also be used early for long-term care. But Dr. Jane's healthy. She's retired. She's happy. She lets this cash sit. She's not putting any more money in. So the 344 just sits and grows until she's 70 years of age. Maybe it's 475,000 at that point. And she says, hey, I'd like to have some money back out of this. And she pulls 45,000 back out of this 100% tax-free, no state tax, no federal tax, doesn't show up on her 1040 at all. And she does that every year for the next many years. I think I took her, let's just take her to age 85 here. She would have put 300,000 in of her own cash, pulled out $677,000 tax-free, still sitting on cash over here of nearly 160, or a death benefit tax-free to her family of 211,000. This is definitely a fantastic alternative that many of my clients take advantage of as a supplement to their work plans and other IRAs or investment accounts they have. All right, moving on. Another option. I have a lot of clients, and maybe you're one of those that, hey, my bank is not giving me any return, and I need a place to put CD money. So let's go over this case. Maybe Will Saver, 70 years of age, conservative bank savings. He's looking for a CD alternative of 300,000 that he wants to put away. Wouldn't mind if it's tax efficient growth and a good wealth transfer vehicle. So similar type account, but different. 300,000 goes in all up front. And our growth is now not tax-free, it's tax deferred. Worst case scenario here. He puts 300,000 in it and we never make him a dime. That 300,000, maybe after 5 years, has only grown to 311. He wants to walk away, walk away. But more than likely, that $300,000 is doing what it needs to do and is growing tax deferred this whole time. And maybe after 10 years, it's grown all the way to $468,000. If Mr. Will isn't with us, that $468,000 turns into $660,000 tax-free, or that death benefit can be used early for long-term care. Just a quick example, say it's worth $468,000, grows all the way to $596,000. He decides to put another $100,000 in. Great. The death benefit didn't go up from $659 to $759. It went all the way to $821. This is a fantastic wealth transfer vehicle. Keeps three things in the fold here. It has good cash growth, safety of money, a CD alternative. It has a tax-free death benefit and a tax-free long-term care benefit. Happy to talk more about those if you're interested. Okay, move on here a little bit. You can see if they sit and grow, they really grow well. But I'd like to give Kathy a chance to talk. I've taken the stage long enough.
Thanks, Mike. And we did have a real quick question. For the last two examples, what assets specifically were you talking about that people would be investing in?
Okay, those two assets are life insurance. It's indexed universal life, and I'm not giving any specific carrier. Many carriers do it. Not all of them do that second one. That's a pretty special product. I'm happy to talk at detail with those. They are considered discriminatory. Not everybody can have them. They're life insurance, so you have to be healthy enough to get it.
Great. Thanks so much, Mike.
Mm-hmm.
So when I have been talking to alums and when I and my colleagues in Plan Giving, I would say the one surprise that they express more often than any others is how much their heirs will be taxed if they are leaving the proceeds of their IRA to someone other than a spouse. And so I always give the example, my uncle lived a very long life, and in his estate plans, he left monies to charity and he left monies in an IRA to me and my brother. So when I have to take those monies out, and I have a limited window now to do that, I need to pay federal tax and estate tax. So the full amount that he would have left to me is pretty highly taxed. You know, I may end up with 60 cents on the dollar for what he left me. What he could have done is he could have left some other assets to me and my brother, which would not have been so highly taxed, and he could have made the charities beneficiaries of his IRA. It's really just switching these two things. And, you know, I'd be happy to talk to folks about that. I'm not going to go into all the details, but generally speaking, it's a really great strategy if you're planning on leaving money to both heirs and to charity. And I'll just go a few more on this. And so there is actually, in addition to just leaving an IRA or some of an IRA to charitable beneficiaries, there's sort of an additional alternative idea that we're going to spell out here. So in the original situation, if you leave your, let's say, a $400,000 IRA to your children, they may only get about $240,000 after taxes, and the government gets $160,000.
Yeah, and this plan we call our legacy plan and have used it with many different clients where, yeah, Kathy, you're right. Most family that inherits an IRA either cashes it out or spends it and ends up losing 40 to 60 cents on the dollar, depending on what state they live in. One option we'll tell clients to do, hey, why don't you take that $400,000 IRA, spend about 1 to 3% of it a year and pay your taxes. And that's where this $22,400 in taxes is going from the rough amount you're taking out each year. to buy a survivorship life policy or individual life policy. So now you switch the beneficiaries of the IRA from your kids or spouse to your favorite charity. The kids become the beneficiary of the life policy, which passes to them 100% tax-free, no state tax, no federal tax. And the charity gets your IRA. And because they're a charity, they don't pay the federal tax on that. And you maximize your giving in your portfolio versus the government plan of giving about $240,000 to giving your kids the original IRA balance of $400,000. The charity gets close to that $400,000 without paying tax. You increase your giving by almost 324%. It's an extremely valuable strategy that we've used many times.
Great. Thanks so much, Mike. So we're going to be wrapping up in a couple minutes to take some more of your questions, but I just wanted to cover a few really important points. So the first is always make sure, well, first to have an estate plan, a will, a trust, and periodically go back and read it. I recently was speaking to somebody who hadn't looked at their documents in quite a long time and had forgotten exactly what they had planned and really needed to make some changes. Also, it is so important to remember that some of your assets will fall under your will or trust, but others you must change the beneficiary form. It will not matter what you write in your will or trust when it comes to these kinds of assets: life insurance, bonds, which have beneficiaries, IRAs, and other retirement plans. So I may decide to shake things up of how I leave things to each of my 3 kids, and I could write that in my will. But whatever it says on my retirement plan, on the beneficiary form, that's who gets that. So you've got to check all of those. And then it is really helpful to let people know, those who most need to know, who, your executors, trustees, in some cases, beneficiaries, because I've also been in a situation where we were the beneficiary of a very generous estate from one of our alums, but their executor was a little surprised to find out that suddenly they needed to play this role, and it was fine, but it's good to let people know. And that kind of leads to our next slide, which is we've talked about a lot of different people that you may want to consult with. So that may include some family members or close friends who may be executors or trustees. It's important to make sure when you're writing up these documents that you have people who are qualified to do so. When you're thinking about these different kinds of investment strategies and how they may impact your tax situation, accountants and financial advisors. And then also, if you're working with the charity, both with your outright giving and estate plan giving, there are charitable giving officers at Jefferson and other charities who would be very happy to help you figure out how you most want to make an impact on that charity and those they serve.
Basically, just wanted to say thank you. I hope we provided some valuable information. Clearly here to stick around and answer some questions for a little bit if more come in. But thanks again.
Thank you so much, Mike and Kathy. We really appreciate your time. And thank you also to everyone who has attended this evening. We did have a couple of questions that have come in, and also a few more that were sent in later today. So kind of going back to the universal life policy, there was a question about universal life policy. Is it with cash value? Is it a good idea to cover future healthcare costs?
Absolutely. You can use the money inside the policy. The cash can be pulled back out tax-free. But in terms of healthcare cost, I think one of the biggest concerns for most folks is long-term care. And one thing that can be used, the death benefit can be used early for long-term care for an indemnity plan where if you qualify for you can't perform 2 of the 5 functions of daily living or get 1 cognitive impairment, that death benefit can be accelerated early, tax-free for care.
Sure. And we've got someone who she's just they were just asking. They were confused about the best way to pay for life insurance. Can you review and contrast them? This person's in the 37% tax bracket.
Yeah, so one idea there for our high income earners, it's not bad to use some of your retirement assets that would flow into other retirement accounts. View it as an alternative Roth IRA. Pay the tax now on your money, put it away tax-free, because not many people want to retire to a lower tax bracket. They want to maintain their standard of living. But one way to do that is to have tax-free income in retirement. This is one vehicle that can do that. So use current income streams, just bleed some away. Or if you're over the age of 59 and a half, it's like a Roth conversion. Use some of your IRA assets each year to convert over to life insurance as a pseudo Roth IRA conversion.
Great, thank you. And someone's just written in, should I use the next plan years, such as 10 years, to move my IRA funds to Roth and insurance?
Yeah, it's kind of what I was just saying. For our clients that have IRAs, we want to definitely put a tax efficient plan together where some each year to fill up those buckets of tax brackets can go into Roth IRA or life insurance.
Okay, great. And what about, how about someone who's living paycheck to paycheck? We did kind of touch on, those with a lower income, but is there anything further that you could kind of discuss as far as paycheck to paycheck? What's the best thing for them to do?
Yeah, that's definitely a tough situation to be in, and hopefully that gets better as career advances. But some of the few things available, that the one is that Savers credit exemption I briefly touched on. That's a way to really not impact your income at all and get a free $1,000 back on your tax return. Put it away and then get it right back into your hands.
Got it. Okay, we've got just time for one more question. So what's the maximum spending in retirement as a percentage of retirement savings that will ensure funds through retirement?
That's a tough one. I'll give you the standard answer of what we're supposed to say in my field as a fiduciary. About 4 to 4.5% is the current standard of spending down your assets. Now, there are alternative investments out there that might guarantee income doesn't run out. Some guaranteed annuities that are out there, some vehicles like that. So it's kind of hard to answer that, but traditionally we're supposed to say 4 to 4.5% of assets.
Got it. Thank you. We did have a couple of more questions that did come in, and Mike, if that's okay, I can email them to you later. And if you wouldn't mind responding to them, we'd appreciate it.
Oh, absolutely.
Okay, lovely. Michael and Kathy, thank you so much for your tips today. We really appreciate your time. And thank you to everyone who attended. We hope that you found this presentation very informative. A recording of the webinar will also be available on the Jefferson Alumni YouTube channel within the next 24 hours. And don't forget, Michael and Kathy's presentation, the Tax Savings Tips Talk from back in November, is also available on our Jefferson Alumni YouTube channel. Please follow us on our social channels to find out more about our upcoming events. You can find us on Facebook, Instagram, Twitter, and LinkedIn, in addition to our Jefferson webpage. And look out for more exclusive online events coming up in June. On June 16th, a panel of Jefferson experts will share running tips, no matter if you're a veteran or beginner runner. On June 24th, The Jefferson College of Nursing will continue its Visiting Scholar Series with Joining Forces with Veterans and Families. Continuing nursing education credit will be available for those who qualify and attend. Registration is also open for these events at jefferson.edu/alumni events. Be sure to sign up for the Jefferson Alumni Network, our brand new community for Jefferson, Textile, and PhilAU alumni, where you can update your profile, search for classmates and fellow alumni, and make new or renew connections. Activate your profile now at alumninetwork.jefferson.edu. Once again, thank you for joining us this evening. I hope you stay well and stay safe. Good night.